The stock market can often feel like an unpredictable beast, especially during a crash. If you've ever checked your portfolio only to see a sea of red, you know that sinking feeling. But what exactly happens to your money during a stock market crash? Let's break it down and explore what history tells us about these turbulent times. When the market takes a nosedive, the immediate impact is clear. The value of your investments, particularly stocks, decreases. This is because a stock market crash is characterized by a significant and rapid drop in stock prices. Historically, these crashes can be triggered by various factors, ranging from economic recessions, geopolitical tensions, to even speculative bubbles bursting. The Great Depression of 1929, the dot-com bubble in the early 2000s, and the financial crisis of 2008 all serve as stark reminders of the volatility inherent in the market. The first key point to understand is the concept of market valuation. Stock prices are influenced by both fundamental factors, like a company's earnings and economic indicators, and psychological factors, such as investor sentiment. In a crash, negative sentiment tends to outweigh fundamentals, leading many investors to panic sell their assets. This mass exodus can further accelerate the decline in stock prices, creating a vicious cycle of fear and selling. Data shows that during the 2008 financial crisis, the S&P 500 index lost nearly 37% of its value in a single year. However, many experts suggest that understanding this cyclical nature of markets can be crucial in maintaining a long-term perspective. Next, let's discuss the actual loss of capital. A common misconception is that you only lose money if you sell during a downturn. When stock prices fall, the value of your holdings decreases, but the loss isn't realized until you decide to sell. Some investors, driven by fear, may sell at a loss to cut further potential losses, while others choose to hold on, riding out the storm. Historically, those who maintain a long-term view can often recover their losses as markets tend to rebound over time. For instance, after the 2008 crash, the market recovered and surpassed its previous highs within a few years. Patience and a clear understanding of your financial goals can be key in these moments of turmoil. Another important aspect to consider is diversification. Many experts suggest that having a diverse portfolio can cushion against the impact of a stock market crash. When one asset class declines, others may hold steady or even rise, thus limiting overall losses. This is where bonds, real estate, and other commodities can play a crucial role. During the 2008 financial meltdown, while equities were plummeting, certain bonds remained stable, preserving capital for those who held them. Diversification doesn't eliminate risk, but it can help manage and mitigate its effects during times of market stress. In addition to diversification, liquidity is a factor that cannot be overlooked. Liquidity refers to how easily assets can be converted to cash without significantly affecting their price. In a crash, liquidity dries up as market participants become risk-averse, making it harder to sell assets at desired prices. This can exacerbate financial strain if you need cash quickly. Many experts suggest maintaining an emergency fund in a liquid form, such as a savings account, which can provide a buffer during financial downturns without forcing you to sell investments at a loss. So, what can you do to navigate the storm of a stock market crash? First, focus on your long-term investment strategy. Historically, markets have shown resilience over extended periods, often recovering from crashes to reach new heights. Keeping your emotions in check and resisting the urge to make impulsive decisions can be vital. Additionally, regularly reviewing and, if necessary, rebalancing your portfolio to align with your risk tolerance and financial goals can help in staying the course. Furthermore, consider the role of education. Understanding the factors that drive market movements, both macroeconomic and company-specific, can prepare you for volatility. Engaging with credible financial news sources, learning about different asset classes, and possibly seeking advice from financial professionals can all contribute to making informed decisions when the going gets tough. Finally, remember that each investor's situation is unique. What works for one might not work for another. Reflect on your financial situation, risk tolerance, and investment goals to tailor a strategy that suits you best. By focusing on the long term and maintaining a diversified portfolio, you can better position yourself to weather the inevitable ups and downs of the stock market. Now, if you found this information helpful and want to stay informed about all things finance, consider subscribing to WealthWire. We're committed to delivering clear, insightful, and data-driven content to help you navigate the world of finance with confidence. Stay tuned for more videos that empower you to make informed financial decisions.